Welcome back. Fannie Mae just revised downward their forecast for home sales through 2025. They also believe that interest rates will be higher than their previous forecast as well. I have a lot to share in today's video. I don't want to waste your time. Let's go ahead and dive right in. This is their actual press release just announced last week. It says their higher mortgage rate forecast leads to a decrease in 2024 home sale expectations. However, though, this is based on existing houses and also new houses through 2025, revised downward from the forecast that was posted 1 month ago, which I'll share with you guys. It says recent inflation data likely to keep rates higher for longer than was previously forecasted. We're not seeing inflation wind down to the 2% rate that the Fed wants to see. And because of that, they actually revised upward their forecast for interest rates through 2025. This group, which is called their ESR group, which stands for their Economic and Strategic Research Group, now expects the 30-year fixed mortgage rate to end the year at 6.4%. So the average rate this year, they're forecasting to be at 6.4%. The daily rate as of today, which is on, Tuesday, March 26, is at 6.91%, according to the Mortgage News Daily. In any case, their forecast this year to be at 6.4% overall is up from the 5.9% they predicted 1 month ago. Strong headline job numbers and a hotter than expected inflation report has led financial markets to price in a less aggressive cutting path by the Federal Reserve. While this group notes that labor market indications are mixed and disinflation will likely resume, it also believes that recent data are unlikely to provide the Fed with a greater confidence it needs to begin easing monetary policy in the near term. In other words, layman terms here, if we were to see inflation dive down to the 2% rate that the Fed wants to see, we would likely see a Fed pivot. In other words, the Fed decreasing the federal funds rate, which would, of course, could cause mortgage rates to decrease as well. However, we're not seeing that just yet because the data coming in is showing that inflation is coming down, but not coming down as much as the Fed wants to see. And that's why last week the Fed decided to pause any rate changes. They're not seeing data coming down to the levels they want to see. Also, according to Doug Duncan, who's Fannie Mae's senior vice president and chief economist, he said the following: the U.S. housing market is likely to continue to face the dual affordability constraints of high home prices and elevated rates in 2024. I will add 2025 as well. Speaking of that, take a look at this. This is from Redfin as of today. It says the typical household earns roughly $30,000 less than what's needed to afford a median price home today. That is an improvement for last year, but overall Americans earn far less than what's needed to buy a median price home in the US. Sad but true. Housing affordability crisis we're having right now. It says buyers need to earn a whopping $114,000 per year to afford a typical US house. That's about 35% more than the typical household actually makes. That is an improvement from October when we had all-time record highs when people needed an income of $121,000 to buy an average price home back then. Redfin also states here that mortgage rates have come down from the recent peak that was set back in mid-October last year, giving buyers a bit more purchasing power, but affordability remains constrained as housing costs grow twice as fast as income. Housing costs is due to the rise in rates and home prices. So take a look at this right here. These are the median list price for all Redfin metros. This is according to Redfin Status Center, looking at asking prices on a national level. So right now, the median list price is approximately $404,000, up by about 5.7% from 1 year ago. Back in mid-October, when rates were averaging around 8%, back in mid-October, which is approximately right there, the median list price at $374,000, quite a bit lower than the $404,000 we're seeing right now. So even though rates have come down from the 10-year high, 10 plus year highs we saw back in October 2023, overall housing affordability is very, very low due to the rise in prices. So much, in fact, that to start the year, we were only up by 3.8% regarding asking prices. Now we're up by about 5.7%. And speaking of that, Redfin noted the following. The median monthly housing payment for home buyers, this is based on interest rates and also, of course, based on asking prices, is at $2,838 per month, down from the all-time record highs of just over $3,000 per month back in October 2023, but up a whopping 74% from February of 2021, when rates were near all-time record lows. And of course, home prices were much lower as well. In fact, don't take my word for it. Take a look at this. Because in February, the median asking price was approximately $329,000. Now it's a whopping $404,000. This means that asking prices compared to February 2021 are up a whopping 23%. So more or less a double whammy, right? Rising in rates, increasing from about 3% to about 7%. So rates more than doubling. And on top of that, home prices increasing by about 23% as well. And this, of course, is why average monthly housing payments have increased a whopping 74% over the past 3 years. In any case, let's get back to Fannie Mae's real estate market predictions. It says, we have revised downward our outlook for home sales this month, largely due to the higher interest rate environment. However, we still expect an upward path in sales over the year, even if there are some bumps along the way. By the way, a very small increase compared to the 28-year low we saw in 2023, though. It also says, we believe an increasing number of transactions or home sales will be driven by households who can no longer put off their moves simply due to the lock-in effect. In other words, people will move due to life events. So death, divorce, relocation, a new job, etc. And because of this, we may see more new listings come on the market, which is exactly what we're seeing right now as well. We're seeing inventory levels rise due to an increase in the number of new listings. In fact, they say here, according to Realtor.com, the flow of new listings, these are people listing their houses for sale, rose by 11.3% this February compared to February of 2023. However, they note, though, a future rise in listings is also expected to outpace the growth in sales. So think of it this way, a bathtub, right? A bathtub is our housing market. The water level in the bathtub is the amount of houses for sale. In order to increase the water level, you need to see more listings hitting the market, more water filling up the bathtub, increasing the water level, or increasing housing inventory. In contrast, what we saw in 2022, we saw a huge decrease of contracts being signed, a huge decrease in home sales. So as more water and more new listings hit the market, the water level increased, even though we saw a relatively low level of new listings. What they're seeing right here is that we're going to see more new listings and then sales, the drain of the bathtub, not draining as fast as the level of new listings hitting the market. So in other words, supply outpacing demand, which will cause inventory levels to rise in 2024. And according to them, that will lead to a gradual loosening of the currently very tight housing market. So in any case, let's get back to overall their forecast this month regarding housing starts. We'll look at home sales, both new and existing home sales. I have a lot of data to share regarding that. And also their home price forecast and their interest rate forecast as well. So let's first talk about housing starts. What I'm more focused on, by the way, is single family housing starts. So what happened in 2023, housing starts for new single family houses. A housing start, by the way, is the beginning phase in the construction of a brand new house. That decreased by 6% last year. but the new forecast is an increase of nearly 7%. Then in 2025, a small increase of 2.7%. In regards to new home sales, let's have a look at this. Because new home sales and also existing home sales both got revised downward compared to their forecast that was posted 1 month ago. So for example, they're now calling for a 4.9% increase in new home sales in 2024 compared to 2023. And then in 2025, another increase of 4.6%. In regards to existing home sales, that's single family, condos, and co-ops, that decreased a whopping 18.7% last year compared to 3.9% for new home construction sales. So here's our forecast for existing home sales. They're calling for 4.215 million existing home sales this year. And that's a small increase of 3%. Their previous forecast was at 4.3 million. So a slight downward revision in their forecast regarding home sales of existing houses. Also, the previous month was calling for 4.7 million existing home sales in 2025. Now it's at 4,666,000. That's an increase of nearly 11% compared to the previous year. So what does this all mean? How does this compare to previous years? And I have this to share with you guys. So I'm going to get a little bit nerdy here, so my apologies. So let's look at 2023. Actually, let's have a look at 2021 first. So 2021, of course, our housing market was absolutely on fire. Home prices and home sales absolutely skyrocketed. So for the year, we had 6,120,000 existing home sales on a national level. And by the way, that was a 15-year high. Then last year, it decreased, or it actually dropped to 4,090,000. That was a 28-year low. So in a span of just 2 years, we went from a 15-year high in sales to a 28-year low, the lowest level since 1995. Huge changes in just 2 years. It's pretty astonishing. Anyways, our forecast for this year at 4.25 million, a small increase of 3% from the previous year, but still down by 21% from 2019 and 2018. Also, as a note right there, besides last year at 4.2 million, that'd be the fewest number of existing home sales since 2010. In other words, extremely low levels as well. Then their forecast in 2025, just under 4.7 million. That'd be an increase of 11% from 2024, but still down by 13% from pre-COVID levels. Also, I did some digging for you guys as well. The median sale numbers, so in other words, historical averages, what we should expect each and every year on average, was at 5,030,000. That's the median number of existing home sales since 1989. What's wild about this is that even though they're calling for a 11% gain in 2025, at 4.66 million, that's still nearly 400,000 fewer compared to long-run averages at 5 million. Even though that would be far less than the long-term historical average over the past 2 decades, that still would be a 3-year high though, because the last time we had at least that amount of home sales was back in 2022, when at that time we had 5 million home sales. All right, let's get back to Fannie Mae's predictions here for 2024 and 2025. I just want to provide that context because it's kind of hard to figure out what is really 4.2 million or 4.66 million. What does that really mean? So I hope that helps out. All right, let's have a look at home prices. This is based on Fannie Mae's HPI, or their home price index. One thing I found to be really interesting is that the quarter-to-quarter peak was at, or actually is calling for that to be this quarter, the first quarter this year, to increase by 7.2% compared to the first quarter 2023. Thereafter, though, they're calling every single quarter thereafter, they're calling for a small increase, or I should say a small decrease each and every quarter, but still in positive territory, by the time we hit Q4 of 2025. So Q4 2025, a small increase of 0.3% compared to the fourth quarter of 2024. So overall, they're calling for a 3.2% rise in prices this year, and then next year, a small gain of 0.3%. And that, by the way, was exactly the same what they forecasted 1 month ago. Another change though regarding rates though, like I mentioned, their forecasts for rates were actually lower last month compared to what we're seeing right now. So our new forecast is for the year to be at 6.6% this year, then to decrease to 6.2% in 2025. Now, nearly everyone is anticipating for a significant decrease in rates this year, but based on their forecast here, overall to be at 6.6%, not a big change compared to the 6.6% rate they're forecasting for the first quarter this year and the second quarter this year as well. So Fannie Mae is now forecasting that rates will be higher than their previous forecasts. Their previous forecast this year was at 6.2%. Now their new forecast is at 6.6%. Also, 1 month ago for 2025, they were predicting that rates were going to dip below 6% down to 5.7%. Now their new predictions is at 6.2% overall for 2025. One more thing I want to mention regarding rates though, is that every single month, or every single quarter, I should say, since Q3 this year, they are predicting that rates will slowly decrease through at least Q4 2025. Fannie Mae is also predicting that we'll see a higher share of refinances compared to previous years. So the share of refinances based on all single-family mortgage originations was at 17% last year, then to increase to 29% next year. And with that said, please comment below your biggest takeaways from today's video. Also, if you guys got any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. Of course, I appreciate you. Hope you guys have an awesome day. I look forward to seeing you on the next video.